Entering today, I had 16 S&P 500 year-end price targets on our graphic that we always put up on screen here and on the website. All of them had stocks ending higher, right? Somewhere in a range of 6,400 to 7,100. Our 17 strategists, Barry Banister from Stifel.
17th to chart.
Finally, we have a bear. Someone says stocks are going to fall, right? And I think when you dig into what Barry's saying here, of course, if someone's telling you that stocks are going to fall in 2025, they're probably going to talk about valuations, right? They're going to talk about how that puts maybe this market rally on a little bit of thinner ice. But what I think is interesting is what Banister's getting at is something that is becoming a little bit part of the discussion right now as far as sticky inflation probably leads to less Fed rate cuts. And then the real kicker is a weaker economy. So one of the things we've talked about with all of these bulls and the large thing that people feel like is going to go well is a better than expected U.S. economy. That's been the trend since post-pandemic, is the U.S. economy has grown better than consensus. Well, Banister thinks the U.S. economy probably grows at about a 1.5% annualized rate in the second half.
How does he get there, Josh?
It seems like overall, it's the impact of higher rates too, Josh. Remember, we're going to come back to that conversation, I think, in 2025, that eventually holding rates higher for longer does something to the economy. It hasn't to this point. That recession that we talked about for 2 years has not come, but there is still a take out there that at some point that's going to happen. He's talking about the consumer here. Consumer spending would slow down, then your economy slows down. And this reminded me, guys, of a chart that we highlighted a week ago in our Morning Brief newsletter that Lori Calvasina shared from RBC on how markets do in different GDP regimes. So if you look at GDP over time, here you go, 1.1 to 2%. So that's Banister's range, right? That's when the S&P 500 has not had positive returns. Where most strategists sort of sit right now would be right below that, predicting GDP in 2.1 to 3%, and you get about an 11% market rally. So again, kind of the key thing here being, if we're expecting the economy to do well, and markets are in large part about expectations, if the economy underperforms, maybe there's a concern not only is the economy slowing, but slowing to a point that we're starting to talk about recession again, and you're starting to price in more risks. Right now, it feels like this market is not pricing in a lot of risks, is something that not just Banister's saying, a lot of strategists are saying that. The market is not pricing in a bad year for the U.S. economy, so if it comes in a little bit worse, that's when you start to talk about pullbacks.
Barry's been bearish, has he not?
He has been, he's been bearish, right. And so I think really, which is why I'm sort of saying the takeaway here is perhaps he's just staying with the risks here that everyone else is a little bit ignoring. But I have heard from a couple strategists in the past week that's been interesting thinking about the different scenarios that a higher inflation regime could lead to in 2025, right? The team over at UBS Asset Management was saying, well, if we have higher inflation and everyone's pricing in these Trump tariffs and these other things that could be inflationary, what if the president-elect decides I don't want to bring up inflation higher and he doesn't do any of the tariffs and all of these things we've been pricing in the market and all of these outcomes don't actually happen? Then maybe your U.S. exceptionalism thing, as you guys were just talking about, the U.S. economy is supposed to do better than other economies, partially because of tariffs, right? If we slap tariffs on all of these other economies, it's in the model, Julie. I see your head moving. It's in the model. It's part of the model, at least. So if you take the tariffs out, then maybe there's opportunity elsewhere outside the U.S. equity market. It doesn't necessarily mean the U.S. equity market doesn't go up.
Just on a relative basis.
But on a relative basis, we're constantly talking about where you can make more money. And maybe there's a chance to make more money elsewhere if tariffs don't come, was one other interesting sort of thread here that's been floated around.
Yeah, well.
We finally have a bear, guys. I don't know. I'm excited.
Like it.
You know?
It's now fun when everybody agrees.
We want bull versus bear.
Of course.
That's when it's exciting.
Of course.
We'll have to get Barry on and we can play it with him.
Bull versus bull is not, not fun. All right, thanks, Josh. Appreciate it.